All right, so now I'm going to walk you through a comprehensive example of a statement of cash flows using the indirect method. Whenever you have one of these statement of cash flows, you kind of have to remember that each single problem is kind of a unique puzzle. And so the reason why we cover statement of cash flows usually at the end of intermediate accounting is because it kind of calls upon all of your accounting knowledge in order to be able to put together the puzzle. And so you're going to find as you do more of these examples that each one is unique and it's got its own twists and turns that you have to walk through. And so the key is using that knowledge, you have to understand how do different accounts and different financial statements relate to each other. And so you've got to understand what goes on the balance sheet, how different accounts are related to the balance sheet, and then also how all those are tied into an income statement. And so again, it does require a lot of accounting knowledge to put one of these together. You cannot memorize this problem and somehow think that that's sufficient to understanding all statement of cash flows problems. You need repetition, you need multiple examples, and that's really the only way to really start to understand how to do a statement of cash flows. But it is helpful to develop a method that will minimize your mistakes. And so this is a way of using an example to teach you a method that I've found allows you to be pretty consistent in solving these problems well. All right, so a couple of things that you have to sort of process and understand. Number one, you have to understand comparative balance sheets. You have to understand the accrual and cash components of an income statement. And then you have to also have an understanding of individual account transactions. And so those three things together are what will allow you to create a statement of cash flows. Again, I think it's important to have a consistent and repeatable approach. I think the first thing to do is to calculate cash flows from operations, and then you move on to the investing activities, which will include analyzing individual transactions, and then finally looking at financing activities, again analyzing individual transactions. And so the comprehensive example that I'm going to do is going to walk you through that process. All right, so we have an example here of an income statement, a multiple step income statement, and also a comparative balance sheet. And so the big thing with the comparative balance sheet, obviously, is we're showing the 2017 balance. And if you could imagine, you go from the 2017 balance through the income statement, and that gets you to the 2018 balance. And so just understand that those two financial statements are related to each other. And so from that example, we're going to do the operating section using the indirect method, and you're going to start with net income. And then you're going to adjust for non-cash expenses, gains, and losses, and then you're going to look at any changes to non-cash current assets and current liabilities. And so, again, we have our two financial statements, and from that, we're going to start into the operating section of the statement of cash flows. A couple of things I want to note real quick. First of all, the statement of cash flows is a flow statement, so it's for the year ending. You can see with the comparative balance sheet, it's as of, meaning it's a point in time. But the income statement and the statement of cash flows, those are flow documents, and so it's for the year ending. And so we start our operating section using net income from our income statement, and then we start looking for the non-cash items. And so in this case, the non-cash items in the income statement are depreciation and amortization expense, and so we have to add that back. And again, the idea here is those are impacts on net income that are non-cash items, non-operating items, and so because of that, we need to adjust net income upwards, and so that's why we add it. And then the next thing is we have to subtract off, or we have to add back losses, and then subtract off any gains. And so we see there was a loss on the bond retirement. That's again a book loss. It's a non-cash item that relates to a financing activity, and so we have to add that back. And then in total, when we've sold assets, we had a net gain, and so that net gain needs to be subtracted from. Again, we're trying to reconcile net income to an operating cash flow, and so we're trying to basically reverse out all the non-cash items from the income statement. That's the first step. Then we start working through our comparative balance sheet, and what we're trying to do here is we're understanding that there are changes in the balance sheet that are not reflected in net income. And so we can basically receive operating cash flows from the way that we handle our receivables that would not necessarily that aren't captured in our income statement. And so, as an example of this first one, if you notice, we started with a balance of $321 in receivables, and then we had an ending balance of $117. And if you kind of imagine, what we're doing there is we're reducing our receivables. Well, if we reduce our receivables, there's no direct impact on our sales, but it does sort of generate additional cash through our operations, just through better handling of receivables. And so that decrease in the AR account basically is an increase to our operating cash flows that is not captured on the income statement. Repeat that process for every single asset, and you can see here our inventory actually increased. And so what that means is we've actually invested cash into our inventory, so that is a decrease to our operating cash flows. That's cash that we're using to buy inventory. It's not creating a cash flow. It's actually a use of cash rather than a source of cash. Prepaid rent. This is an idea where somebody's paying us, or we are paying rent ahead of time. And so you can see that at the beginning, the balance was 20, and that balance increased to 34, which basically means we're using more cash for prepaid rent. And therefore, there's going to be a negative impact on our operating cash flow. Now that's the end of our current assets, and so now we have to move to our current liabilities. And so with the accounts payable, remember this is a liability, and we're talking about operating cash flows. And you can see that at the beginning we had $112, and at the end we had $158. And what you can see is that basically by creating more payables, we're freeing up more cash. And so there's a source of cash by allowing that balance in the account payable to grow. A similar effect from salaries. So we had a beginning balance of 24 and an ending balance of 31, which means that payable is growing. And since the payable is growing, again, that's providing more cash in terms of an operating cash flow. There's an opposite effect with unearned revenue. We can see that the balance decreased, which means we're using cash. We're using up more of our cash that we would generate from unearned revenue. And again, that's now the end of our current liabilities. And so now we've taken into account all the adjustments from the comparative balance sheet for our current assets and our current liabilities. So we sum all that up, and we can see that cash provided by operations is $911. A positive cash flow from operations is pretty typical, and it's expected. Maybe young companies that are just starting out might have negative operating cash flows, but generally speaking, you want to see positive cash flows from operations. So the next section is the investing cash flows section. So you have to look at each non-current asset account, and you have to walk through transactions and additional information, and then think about the effects of gains and losses if there are any assets that were sold. And so some additional information that would be necessary, I just kind of laundry listed out here. First of all, there's some bad debt expense that we're going to talk about. This isn't relevant for the investing section, but it will be relevant when we do the direct method, or if we were to do the direct method for our operating section. Now we're starting to see some things that matter. And so there was a purchase of land, issuing a bond, and then also a purchase that included a cash purchase. And there was also a loss when there was a sale. There was an acquisition of property, plant, and equipment. Again, so both of those accounts are non-current assets, and so we need to pay attention to those two disclosures. And there was some other information with regards to bonds and common stock, which will come into play with our financing section. And then finally, I give you the depreciation expense, and there's going to be just an assumption we always have that anything not listed here is a cash transaction. That just is a simplifying assumption. Okay, so the way we kind of work through this again is start with each individual account. And so we have our land account. There's a beginning balance of $633. From the additional information, we know that there was a purchase using a bond, so we add that information in. There's also the cash purchase, so an additional $213 there, which means we really should see, if there was nothing else going on, there's an implied balance where what we should see is a balance of $871. But what we actually see is a balance of $741. And so given that our assumption is that anything not explicitly listed must have been from a cash transaction, be the case that there was an implied sale. And so there must have been a sale of $130 of our land. But that's not sufficient. So in other words, the cost, the land account, is carried at cost. But in this particular case, we were told there was a $31 loss. And so the cost of the land was $130, and if there was a $31 loss, that means we must have received only $99. And so we take that information and we put it into the investing section of the statement of cash flows. The sale of land was a $99 cash sale, and in the purchase of land, we spent $213. So the next account is the net property, plant, and equipment account. I kind of combined a gross property, plant, and equipment account with accumulated depreciation just to kind of illustrate some things and get you to think a little more. And so again, we have our beginning balance of $843. We were told there was a stock purchase of $100 that would increase our PP&E account balance. And then there was a sale, and so we were told that the original cost was $321 and the accumulated depreciation related to the item sold was $83. And so the net effect is that when the sale took place, the account balance decreased $238, and so that accounts for the sale. Of course, that's not sufficient because we know there was also a gain, and so the key is the total gains and losses were $112. We already told there was a $31 loss when we sold our land. That implies that the sale of PP&E should have had a gain of $143. Again, this is this idea where we're putting together a puzzle. And so given that the book value of the asset that was sold was $238 and that there was a gain of $143, that implies I must have received cash of $381. We're also told that there was depreciation expense, which would decrease that net account. And so if that's all that had happened, our balance should have been $545. But we can see that the actual balance was $960, and so with the assumption that everything not specifically listed was a cash transaction, it means that there must have been a cash purchase of PP&E of $415. So we take that bit of information and we add the cash sale and we subtract the cash purchase from our investing cash flows. And then finally we have to think about that patent account. And we can see that, again, we have to put together a bit of a puzzle. We can see that depreciation and amortization expense totaled $165. We were told that $160 of that was depreciation, which means $5 must have been amortization. And you just have to remember that amortization goes as a direct decrease to the patent account. And so that $5 decrease from 42 down to 37 is entirely explained by amortization, meaning there was no sale and no purchase of patents. And so with that information then, we can see that there was a negative cash flow from investing activities, and that would be then cash used by investing activities. Again, this is probably typical. We typically would want to see a negative cash flow with investing activities. That means in total you're purchasing more assets than you're selling. So now we move to our financing section. And so again, you have to examine each account. You have to look at transactions, additional information, and gains and losses when it comes to debt retirements. And so the additional information I've highlighted in gold, the fact there was an issuance of a bond, an issuance of some stock, and then there were some cash issuances and retirements or repurchases as well. And so looking at our bonds payable account, we have the beginning balance. We are told about the land purchase, and we're told about the issuance. And so that's a cash issuance of $118. So with that information, we should have a balance of $585 in our bonds payable account. However, we see the actual balance is $272. What that implies is there must have been a $313 retirement. Now the key though is in the bond payable account, the retirement is going to be at cost when it comes out of that account. And so given the fact that there was a $15 loss, so we have a cost of $313 and a loss on retirement of $15, it means that I must have paid more than the cost. And so the cash that I must have paid to retire my bonds is $328. And again, we are after the financing cash flow, and so that's why we had to do that separate calculation. And so we can see the bond issuance and the bond retirement listed there underneath our financing section of the statement of cash flows. So now we have our common stock account. We have a beginning balance. We are told there was a $100 issuance. We're also told there was a $217 repurchase. And so with that information, it means we should have a balance in our common stock account of $1,565. However, we see that the balance actually is $1,623. Using the same logic, that means there must have been an issuance of $58. So now we include those items in our financing section of the statement of cash flows as well. The repurchase of $217 and the issuance of $58. Again, we're just putting together the puzzle. And then finally, we have to think about that retained earnings account that deals with dividends. And so that's why we have to pay attention to it. We have our beginning balance of $664. We know that it increases with net income. It means all else equal, the implied balance would be $1,309. We compare that to the actual balance of $1,182. There must have been a dividend of $127. We don't see any dividend payable account or anything like that, which means, again, with that assumption that everything's a cash transaction, unless otherwise stated, that must have been a $127 cash dividend. So we include all that information, and we can see that in total we have $496 a negative cash flow, which means that's cash used by financing. There really isn't necessarily an expectation here. Generally speaking, it's going to fluctuate over time. It just means that for whatever reason, they are retiring a lot of debt, repurchasing a lot of stock, and all you'd want to do is look at the notes to see maybe why that was happening. All right, so now we have our three main sections of the statement of cash flows: the operating section, which we've calculated, the investing section, and the financing section. And then the bottom section of the statement of cash flows, normally this would be sort of vertical, but obviously with the way this is oriented, I didn't have room. But the bottom section of the statement of cash flows, you sort of calculate the net change in cash, which in this case is $267. We add that to the beginning cash, which gives us our ending cash balance. And then additionally, we many times, or we have to disclose any significant non-cash transactions. And in this case, there were two: the land purchase and the property, plant, and equipment purchase.